Hey guys, we are talking about all things when it comes to assumable loans. If you've never heard of it before, check it out because you're going to be able to find out why it's so important and how much money it could really save you. All right, so assumable loans. Let's talk about these. Not a whole lot to cover here, but
they exist.
Yeah, they absolutely exist. And some of you may be wondering, what in the world is an assumable loan? How would that even benefit me? So let's talk about it. What is an assumable loan?
Yes. So for any government-backed, government-insured loan, so FHA, VA, USDA, it is possible to assume someone's mortgage. So if someone has a mortgage and they're selling their house, you as the buyer can actually pick up where they left off.
Okay. And so really where that can be most advantageous for somebody is if the seller of a property has an assumable loan and they have a really good interest rate. So for example, from 5 years ago, if somebody may have gotten an interest rate in 2.5%, like one of those crazy rock bottom interest rates. If they have an assumable loan, now when interest rates might be, much higher, how does that really help a buyer?
Yeah, you can absolutely take advantage of yesterday's rate, basically, a rate that's not available anymore.
Yeah, so you can assume as a buyer, if you qualify to assume it, you can assume that 2.5% interest rate, for example, instead of maybe a 6% rate, or whatever, the day's rate might be today. So you could actually get a much lower monthly payment.
That's right. It's possible.
So, but when you assume a loan, you're not just only assuming that amount, correct? There could be times where you actually have to pay a little bit more.
Yes. So there might be a gap and a delta between what the loan you would need to take out for the home and where that loan is currently, how much is owed. So that's a conversation to have with your loan officer is how can we assume a portion of the loan and be able to purchase the whole home.
So market rate or market price for a home. So just for the sake of example, if the assumable amount of a mortgage or what's owed on an assumable loan, let's just say is $200,000, but the home is worth $400,000. So you could assume again, for our example, the 2.5% rate on the $200,000
on that portion.
But for the other $200,000 that you're buying it for, you would actually take a second mortgage out at whatever the current market rate is, right?
Correct. Or pay cash.
I wish we could all just pay cash. If we all paid cash,
I don't.
Yeah,
I'd find something else to do with my time.
Yeah, you wouldn't have a job. But it is an important conversation to have, is to understand what are the benefits, what are the savings you can get by assuming a loan, understanding if you have to take out something to cover that difference of the market value, that exactly what your affordability looks like, what that payment looks like for you every month.
Yes.
Okay. Awesome.
And if you're curious if your current loan would be assumable, if you're wanting to sell, you can actually look on your closing disclosure. It'll check, yes, it will be assumable, or no, it will not.
Important to know. So if you're buying a house, that's an important question because not everybody's going to know their loan could be assumable. So ask the selling agent whether or not that loan is assumable, because you might be able to save yourself a boatload of money.
That's right.
So that's it, guys. Thanks for tuning in. Stay tuned next time. We got more things to talk about when it comes to all things lending, when it comes to buying a house. Lauren, thank you as always. You're a rock star.
Thanks, Chris. Bye.